Hey everyone, welcome to The Explainer. Today we're doing something really exciting. We are going to do a deep dive into an absolutely killer real-world trade involving two massive enterprise software titans, Salesforce and Atlassian. Whether you're building a long-term retirement portfolio or you're just hunting for short-term tactical setups, understanding exactly how a trade goes from a simple thesis to a massive gain is literally invaluable. So today, I'm going to take you under the hood of both of these SaaS powerhouses. I'll state the exact prices I bought in at, unpack their business models, and figure out what the data tells us to do next. To do that, we've got a pretty tight agenda. We are going to hit the portfolio entry points, dive into their business models and moats, unpack a SWOT analysis and their leadership, crunch the latest financial statements and intrinsic valuation for long-term investment, look at a brief technical analysis for short-term trading, and then cap it off with our final strategy and next steps. All right, Section 1, the portfolio entry points. Let's look at the first position in this trade. Back in May, I bought Salesforce, ticker CRM, at exactly $160. Right now, it's hovering around $196, so that's a really solid 22.5% gain. Why did I pull the trigger? Basically, I caught Salesforce trading near its 52-week lows. It gave us a massive margin of safety on what is, at its core, just an absolute cash cow of a business. But then we have the rocket ship of the portfolio. I bought Atlassian, ticker TEAM, at $77. Today, it's trading near $162. That is a massive 110.3% gain. Getting in at 77 meant we essentially nailed a generational bottom, catching it right above its absolute low of $56. So we've got this steady 22% gainer on one hand and a hyper-growth triple-digit gainer on the other. Let's dig into exactly why these played out the way they did. Moving on to Section 2, business models and moats. When you look at both of these companies, their absolute secret weapon is friction. They create incredible friction for their customers if they ever try to leave. Salesforce has a massive, wide economic moat built on network effects and intensely high switching costs. Their CRM data is literally mission critical. It's tied into data lakes, ERPs, the whole shebang. Ripping out Salesforce would cost an enterprise millions of dollars in sheer operational downtime. On the flip side, Atlassian has a narrow to wide moat. They are deeply, deeply embedded in the developer and IT infrastructure layer. Imagine trying to replace Jira across thousands of engineers. You would completely derail agile delivery cycles. So both companies basically make it agonizingly painful for any customer to jump ship. Section 3, SWOT analysis and leadership. Let's break down the Salesforce SWOT first. Obviously, their biggest strength is dominant market share and their massive multi-cloud ecosystem. But the weaknesses? Organic core growth is definitely slowing down, and they've historically leaned really heavily on M&A, like when they bought Slack and Tableau. Looking at opportunities, visionary founder and CEO Mark Benioff is going all in on monetizing autonomous AI agents through Agentforce, which is a huge opportunity for sure. But he's doing this while trying to fend off threats from AI disruption that could seriously erode their traditional seat-based pricing. Oh, and it's absolutely worth mentioning that activist investor pressure has recently forced Benioff into much stricter financial discipline, which is a major dynamic here. Now, let's contrast that with Atlassian SWOT. They are now under the sole leadership of CEO Mike Cannon-Brookes, since co-CEO Scott Farquhar recently stepped down to the board. Atlassian is built on a hardcore engineering-first culture. Their ultimate strength is just insane product stickiness driven by a product-led growth model. The weakness, though, is the friction they're facing migrating legacy enterprise clients off old on-premise servers and into the cloud. They do have a huge opportunity to expand Jira into enterprise service management, but the threats are very real, primarily from developer workflow competitors like GitHub and the rapid rise of internal AI code assistants. Up next, Section 4, financial statements and valuation. If you look at the dual-track nature of this trade, the contrast is pretty stark visually. Salesforce is chugging along with steady, moderate 10% year-over-year revenue growth. Meanwhile, Atlassian is just surging. They posted a 28% year-over-year hyper-growth rebound, and a lot of that is being driven by their cloud revenue, which accelerated at an incredible 31%. For Salesforce, the financial story is all about that cash cow profile. They just hit $41.5 billion in revenue, and that Agentforce ARR we talked about is expanding by a staggering 169%. But you really have to look at the profitability. $14.4 billion in free cash flow. That is an exceptional 34.7% margin. On top of that, management authorized a massive $50 billion share repurchase program and bumped up the dividend. When we run the discounted cash flow models for long-term investment, Intrinsic value is sitting between $220 and $240 a share. So at around $196 today, it's fairly valued, but it's an incredibly solid defensive hold. Contrast that financial profile with Atlassian. They pulled in $1.76 billion in quarterly revenue. But the real headline here is that they successfully swung back into GAAP profitability, delivering $139 million in GAAP net income. They pumped out $475 million in free cash flow, giving them a 27% margin. Our intrinsic value estimate for Team, assuming a normalized 20% plus growth rate, comes out to $140 to $155 a share. Section 5. Technical Analysis for Trading. Looking at a brief TA for short-term trading, Salesforce is in the middle of a nice intermediate-term bullish reversal. It broke out above its descending channel right near $187. Its RSI is neutral to bullish, which means there's still plenty of room for upside before hitting resistance at $205. Atlassian, though, is a totally different beast right now. It's printing a strong double breakout structure on the daily and weekly charts, and it reclaimed the neckline of a rounded bottom. But its RSI is up over 72. That puts it squarely in short-term overbought territory after its post-earnings gap up. Immediate resistance is sitting right near consensus price targets of about $165. Finally, Section 6, Strategy and Next Steps. So based on all of that, here is the actual playbook and portfolio instructions to take away today. Step 1. It is time to take action on Atlassian. You're sitting on a greater than 100% gain, and your initial thesis has played out incredibly fast. Because the stock is trading around 162, which is just above our intrinsic value estimate of 155, and it's technically overbought, the smart move is to trim a portion to rebalance your risk, or at the very least, set a tight trailing stop loss. Step 2. Hold Salesforce. It's still slightly undervalued compared to that $220 intrinsic value estimate. It has massive free cash flow, and it gives your portfolio excellent defensive, core enterprise exposure. And that wraps up our breakdown. We've literally seen how catching a falling knife at a generational bottom, like we did with Atlassian, can double your money, while buying a cash-generating behemoth like Salesforce with a margin of safety provides that steady, reliable growth. But I want to leave you with a question to chew on. How do you weigh long-term moats against short-term technical breakouts in your own portfolio? Do you let your overbought winners ride, or do you stick strictly to intrinsic value? Keep using structured frameworks exactly like this to evaluate your trades, and you will be well on your way to answering that for yourself. Thanks for joining me on this explainer, and I'll catch you next time.